Stop. Imagine it's the morning of January 3rd, 2026, and your feed is flooded with urgent alerts from precious metals analysts claiming a full-scale bank war has erupted right on the COMEX trading floor. Reports allege that Deutsche Bank was compelled to issue massive delivery notices totaling 3 million ounces of physical silver in a single day, while JPMorgan positioned itself to stop, or take, 80% of those deliveries, effectively vacuuming up the lion's share of available metal. At the same time, major retail dealers are supposedly flashing sold-out signs across their sites for iconic products like American Silver Eagles, with buyers facing indefinite delays or premiums that make physical ownership feel out of reach for the average person. Is this the undeniable evidence that the long-suspected suppression mechanism in silver is finally imploding from within, with former allies now fighting over the last scraps of real metal as physical scarcity overwhelms paper control? Welcome to Cash Historian, where we delve deep into the unspoken history of money, chart the unstoppable rise of global debt burdens, expose the carefully guarded operations of central banking systems, and confront the stubborn economic paradoxes that continue to shape wealth, power, and opportunity in ways most people never fully grasp. Today, we are carefully dissecting these intense claims that have dominated discussions in the opening days of 2026. Allegations of interbank raids, dramatic vault shifts, and sudden retail shortages, and working to distinguish solid, verifiable developments from the interpretive layers that can turn ordinary market mechanics into narratives of imminent collapse. These kinds of stories gain traction quickly because they resonate with a suspicion that has persisted for generations. The idea that major financial institutions have, over decades, exerted outsized influence on precious metals pricing to maintain stability in broader debt-based systems. The excitement around supposed delivery spikes and bank-on-bank conflict feels like the culmination of years of watching concentrated short positions cap rallies time and again. But to determine if we are truly at a historic inflection point or simply seeing heightened volatility interpreted through a familiar lens, we must follow the complete historical thread, from silver's ancient role as sound money to the modern era of derivatives dominance, and examine how cause and effect have repeatedly favored managed outcomes over chaotic repricing. Silver's status as a cornerstone of honest money is as old as civilization itself. The earliest known coins, minted in the Kingdom of Lydia in modern-day Turkey around 600 BC, were made from electrum, a natural gold-silver alloy that provided a reliable medium of exchange for growing trade networks. As empires expanded, silver became indispensable. The Athenian drachma powered classical Greece. The Roman denarius, initially nearly pure silver, served as the reserve currency of the Mediterranean world for centuries, until successive emperors reduced its silver content through debasement, a quiet tax on citizens that fueled inflation and contributed to economic instability during the empire's decline. In the age of exploration, vast silver flows from Spanish mines in Potosi and Mexico flooded global markets, backing the pieces of eight that became the first truly international currency, accepted from Manila to Madrid. When the United States declared independence, the founders were acutely aware of this history and the dangers of fiat excess. They had experienced the continental dollar's hyperinflation during the Revolutionary War. Not worth a continental became a lasting phrase for worthless paper. The Constitution's Article 1, Section 10 was explicit. No state could make anything but gold and silver coin a tender in payment of debts. Congress was granted power to coin money and regulate its value, and the Coinage Act of 1792 defined the dollar as a fixed weight, 371.25 grains of pure silver, with a bimetallic ratio tying it to gold at 15:1. This system imposed real limits. Governments and banks could expand credit only as far as they could acquire physical metal, preventing runaway borrowing. Yet those limits were never universally welcomed. Economic growth in the 19th century, railroads, factories, westward expansion, demanded more elastic money supply. Massive silver discoveries in the American West, particularly the Comstock lode in Nevada during the 1850s and 1860s, dramatically increased supply, which benefited debtors by easing repayment in cheaper dollars, but threatened creditors with falling purchasing power. Eastern banking elites, centered in New York and aligned with European finance, preferred a tighter gold standard. In 1873, Congress passed legislation that effectively ended free coinage of silver into dollars, an action Western mining interests and farmers condemned as the crime of 1873, a deliberate demonetization timed to favor creditors. The backlash fueled the populist movement, finding voice in William Jennings Bryan's 1896 presidential campaign and his electrifying Cross of Gold speech, where he warned that abandoning silver would crucify mankind upon a cross of gold controlled by moneyed interests. Bryan's defeat and the Gold Standard Act of 1900 solidified gold's dominance, shifting power further toward centralized finance. The early 20th century brought crises that exposed the gold standard's rigidity. The Panic of 1907 saw bank runs and stock market collapse, with JPMorgan personally organizing bailouts. This chaos provided the justification for reform. In 1910, a small group, including Senator Nelson Aldrich, Paul Warburg of Kuhn, Loeb and Cobers, and representatives of Morgan interests, met secretly on Jekyll Island, Georgia, to draft plans for a central bank. The resulting Federal Reserve Act of 1913 created the Fed as a hybrid public-private entity with monopoly power over note issuance and the ability to expand credit through fractional reserves, all while the dollar remained tied to gold. World War I shattered the classical gold standard as nations suspended convertibility to print money for war efforts. The 1920s brought unstable attempts to restore it, followed by the Great Depression. In 1933, President Roosevelt declared a bank holiday, then issued Executive Order 6102, requiring citizens to turn in gold holdings above small exemptions, effectively confiscating private gold to revalue the dollar upward against it by 69%. The 1934 Silver Purchase Act followed, directing the Treasury to buy silver at above-market prices, partly to support Western mining states, and partly to inject monetary expansion during deflationary times. Post-World War II, the Bretton Woods system pegged currencies to the dollar and the dollar to gold at $35 an ounce. But U.S. spending on the Vietnam War and Great Society programs created persistent deficits, draining gold reserves as foreign central banks redeemed dollars. Silver faced parallel pressure and was removed from circulating U.S. coins in 1965 amid shortages. The system cracked in 1971 when President Nixon suspended gold convertibility, closing the gold window and ushering in pure fiat currency. Money created without commodity backing, limited only by policy discretion. The 1970s inflation surge that followed punished savers and rewarded asset holders. Into this environment stepped Nelson Bunker Hunt and his brother William Herbert Hunt, Texas oil billionaires convinced fiat debasement was terminal. Beginning in the mid-1970s, they built enormous positions in silver futures and physical metal, eventually controlling contracts representing over 200 million ounces alongside allies. Prices rocketed from around $6 in 1978 to over $50 by January 1980, demonstrating how concentrated physical-backed demand could challenge paper markets. The response was decisive. COMEX and regulators raised margin requirements multiple times, imposed position limits restricting new long positions for large holders, and allowed only liquidation orders in certain cases. On March 27, 1980, Silver Thursday, the price collapsed more than 50% in a single day amid cascading margin calls. The Hunts faced billions in losses, declared bankruptcy, and were later fined for attempting to corner the market. Exchanges had demonstrated their ability to alter rules when faced with existential threats, protecting the broader financial architecture. The decades since have seen refined versions of price management. Bullion banks developed massive short positions in futures markets, often several times annual global mine production, consistently appearing to cap upward moves. Central bank silver leasing programs temporarily flooded supply. In the 2000s and 2010s, JPMorgan's dominance drew scrutiny after inheriting Bear Stearns' large short book in 2008. Independent analysts documented concentrated commercial net shorts exceeding 200 million ounces at peaks. CFTC investigations and lawsuits revealed manipulative practices like spoofing, placing and canceling orders to mislead algorithms, culminating in JPMorgan admitting wrongdoing and paying nearly $1 billion in penalties between 2019 and 2021. Former CFTC officials publicly acknowledged long-term manipulation. Yet the structure persisted, serving to keep industrial costs predictable and discourage mass exodus from fiat during waves of quantitative easing. That QE has been epical. The Federal Reserve's balance sheet expanded from under $1 trillion pre-2008 to nearly $9 trillion post-COVID. U.S. national debt now exceeds $36 trillion, with annual interest payments approaching $1 trillion, surpassing defense spending and sustained only through Fed monetization and global dollar reserve status. Debt ceiling negotiations have become recurring political rituals, always resolved with higher limits because default is unthinkable. In Canada, the trajectory is strikingly parallel. Federal debt has more than doubled in recent years, exceeding 100% of GDP when provincial obligations are factored in. Ultra-low rates and Bank of Canada asset purchases fueled extreme housing inflation in cities like Toronto, Vancouver, Calgary, and Montreal, where average home prices have detached dramatically from median incomes, turning ownership into a generational impossibility for many while enriching asset holders. All this relies on confidence in perpetual fiat expansion. When that confidence wavers, as it has in Japan with decades of stagnation and yen weakening, people seek alternatives. Japan's debt-to-GDP ratio tops 250%, yet savers long tolerated low yields. Recent years saw shifts into gold and silver as purchasing power eroded. Entering 2026, silver carries momentum from 2025's strong performance amid industrial demand growth in solar panels, electric vehicles, electronics, and defense applications. Spot prices have shown volatility, trading in the low to mid-70s with occasional dips from index fund rebalancing. China's January 1st implementation of export licensing for strategic metals, including silver, restricts approvals primarily to state-affiliated entities, prioritizing domestic consumption, where internal deficits already run deep due to exploding solar and tech needs. This policy shift contributes to real tightness, particularly in Asian physical markets where premiums have widened. However, the specific claims of extraordinary January COMEX events require closer scrutiny. Official CME delivery reports for the first trading days of 2026 reflect standard volumes for a contract rollover month. Hundreds of notices, not the thousands implied by multi-million-ounce raids. Registered and eligible vault stocks remain within operational ranges established over recent years, with fluctuations consistent with seasonal and positioning adjustments rather than acute drains. No public issuer stopper breakdowns confirm targeted transfers of 3 million ounces from Deutsche Bank or JPMorgan, dominating 80% of stops. Retail dealer inventories tell a similar story of elevated but manageable demand. Sites like AppMex, SD Bullion, and Kitco show 2026 dated American Silver Eagles available through pre-sales or with standard shipment timelines tied to U.S. Mint release schedules, typically mid to late January for fresh strikes, rather than complete blackouts or indefinite delays. Premiums are higher than historical averages, often in the $15 to $25 range over spot for popular coins amid post-holiday restocking. But supply chains continue functioning through established wholesale and mint channels. The gap between narrative and data highlights how routine early-month mechanics, contract expirations, position rolls, holiday-delayed reporting, can fuel interpretive excitement when overlaid on genuine structural trends like China's supply curtailment. Banks continuously adjust exposures. JPMorgan has built substantial vault holdings over years while trimming pure speculative shorts. No verified evidence points to a breakdown of long-standing coordination or predatory cannibalization threatening systemic stability. Historical patterns offer perspective. Interventions in 1980 preserved the system when challenged. Similar tools, margin changes, settlement flexibility, regulatory oversight, remain available today. Yet the collision between finite physical supply and unlimited monetary creation generates persistent pressure, amplified now by geopolitical resource strategies. For citizens in the U.S. and Canada, grappling with eroding real wages, inaccessible housing, and public debts that compound without clear resolution, these market episodes serve as reminders of underlying vulnerabilities. Confidence can shift gradually, then suddenly. Here are 3 critical takeaways as we monitor developments. First, extraordinary claims about delivery raids and vault crises demand direct verification from primary CME sources, as early contract month flows frequently reflect technical positioning rather than fundamental breakdowns. Second, geopolitical policies like China's export controls introduce durable supply constraints that derivative markets and financial influence cannot indefinitely override. Third, direct physical possession remains the only position immune to exchange rule adjustments or paper repricing mechanisms, aligning purely with underlying scarcity dynamics. The central question lingering over 2026. With industrial and strategic offtake accelerating against newly restricted flows, will recurring volatility eventually compel a broader acknowledgement of physical reality, or will established tools continue to manage perceptions effectively? We are observing the ongoing evolution of monetary systems in real time. Remain vigilant and informed. If this thorough examination helped clarify the difference between heightened market stress and outright systemic rupture, please like the video, share your perspective on silver's path ahead in the comments, and subscribe to Cash Historian for continued in-depth coverage of debt trajectories, central bank operations, and the paradoxes that guard lasting wealth. Activate notifications because these stories develop rapidly. Thank you for watching. And never forget that clear understanding is the strongest foundation in times of uncertainty.